Hi everybody, it is the Thursday Financial Thing live stream. I am your host, Mr. Lawrence. How is everybody doing this evening? As you can tell, we have a vacant Harley Cam today because she is out on an adventure with a family member. So she will not be making an appearance, but that doesn't mean to say we can't give her a little bit of consideration nonetheless. I hope you are having a wonderful Thursday. Try to get through things quickly this evening for you. We're going to talk about some peer-to-peer lending and go into the mailbag. We got an interesting email from a few weeks ago, which I really enjoyed. I wanted to show it to you. But we are going to talk about peer-to-peer. Somebody asked me also this week via email, why do I cover other things aside of peer-to-peer lending on this live stream? Well, there is one reason, because I keep getting messages from people asking me about investing, right? And I have to cover other things. I enjoy covering other things, and I think it really highlights the importance of diversification. I continue to see people who put all of their eggs into one basket of investing. I've seen people put 100% of their net worth into peer-to-peer lending and absolutely get crushed. I've seen also the same with stocks, the same with cryptocurrencies. So I think it's important that for everybody who isn't into just peer-to-peer lending to know that there are other forms of investing and that you should 100%, of course not financial advice, but 100% you should always diversify, because if one thing isn't going to plan, Landy, funding secure, then you have other things and other forms of diversification to really bail you out. And I know people that have put their entire net worth into Tesla stock that has gone down 30-40%, and it's just kind of ridiculous. But that is one reason why I continue to talk about other things aside of peer-to-peer. I think that personally I invest in all different things, not just solely peer-to-peer lending. I do really want to get that message out of financial education. This is the reason why I do this, certainly not for money-making reasons. I do it really to get the message out and just to educate people who may not know. I mean, you guys are always here and you're very experienced, but there are people that watch the videos on catch-up that do not know about other things, and some of them don't know about basic investing, so that's why I do that. Anyway, hit me with that thumbs up if you can. Helps out the channel a lot. Quick shout out to our sponsor of the stream, Cufflink. You know what the deal is. You can earn well over 9.83% of gross per interest annum now. Over £300 million of property-backed UK investments made since 2016. Zero investor losses to date. Remember, your capital is at risk. Don't invest unless you're prepared to lose money. This rate can change as interest rates do change. Sign up in the link below if you don't have an account. You want to have a look around. join.cufflink.com/financial-thing. Thank you to them for sponsoring the channel. Appreciate that. So let's get right into the news, and then we're going to look at a couple of other things. Here we go. Folk to folk, IFISA to remain peer-to-peer lending focused. And there you go. You can see Roy Warren there out and about in the English countryside. This is an article which is considered a partnership, so it's kind of more of an advertising piece, but I still find it interesting. Folk to Folks Innovative Finance ISA, or the IFISA. IFISA? I don't even know how to say that right. If any of you know how to say it right, let me know. But it will remain focused on secure peer-to-peer lending investments despite recent changes to the IFISA remit. I don't even know what that word means, to be honest, but there you go. From April the 6th, 2024, the IFISA will be extended to cover open-ended property funds and long-term asset funds in addition to peer-to-peer lending loans. This has led to speculation that some IFISA managers could expand their offerings. However, folk to vote, Mr. Warren say that his platform will stay true to its peer-to-peer lending roots. Roy said that the new rules mean there will be greater range of permitted investments beyond peer-to-peer lending that can be held within IFISA, which will likely raise the profile of this little known ISA. I'm not sure that it will. Personally, I don't know that open-ended property funds or long-term asset funds are really common knowledge among inexperienced investors. Probably some people don't even know what those are, but it may help to raise the profile a little bit. Royal also said, however, investments into peer-to-peer loans will remain the only investment option within folk-to-folks IFISA. Kind of makes sense. I mean, folk-to-folk is not planning on changing their product offering anytime soon, so that is good to know. Let's see, our friends over at BLEN Network sent out an email today that said, yes, BLEN has been shortlisted in the FinTech Company of the Year category at the prestigious FinTech Awards in London. Well done, BLEN. I think BLEN continues to do a good job over there. This email says that BLEN will be battling it out to be crowned winner at the grand finale on the 12th of June against some of the heavyweight names in finance such as Zopa Bank and Alika Bank. The FinTech Awards in London are designed to recognize, attract, and invest in the talented FinTech companies and professionals working in London. It recognizes the achievements of the thriving FinTech sector across the country, bringing lead innovators and digital experts together in an evening of celebration. Well done to BLEN for being shortlisted for the FinTech Company of the Year. It's pretty hard to beat huge companies like Zopa, but BLEN is getting in the ring with them, and they'll punch it out, hopefully, for a knockout and not a decision victory. I don't know why I'm talking about boxing, but they said they'll be battling it out some of the heavyweights, so there you go. Shun is going to be making their peer-to-peer lending more accessible. As we know, before the IFISA period ended, Shun knocked their minimum investment rates down from £5,000 to £1,000. Well, here you can see Jatin Ondia, with a very nice shirt on, gave a video presentation to say that this £1,000 minimum is going to be permanent now. So for anybody that wasn't investing in Shun because of that high £5,000 minimum investment, now you can give it a shot for just £1,000, and that's going to be a permanent offering, which I think is really, really, really good thing. I've always advocated for, I think lower minimums are good. I understand that it takes more to maintain smaller investments on an administrative side for the company, but I also think that when you have a £5,000 minimum investment amount, you're really cutting down on the amount of people that are going to give you a try at the very least. Most investors like myself are not going to put in a £5,000 minimum amount to start, feeling much more comfortable going in at £1,000 or less. So that's going to be the case now for Shun. Interesting, on the Landlord Invest, last year I remember in 2023 they posted some data about the platform. Now, Landlord Invest, of course, we've had Philip on here, one of the founders of Landlord Invest, the founder. It's not a huge peer-to-peer lending company. You can see through some of the statistics that they posted in here, but they're definitely growing. I think that's a good thing. It says since March of 2017, Landlord Invest has completed a total of 115 loans with the value of £18.4 million, and 92 of those loans have been repaid in full, and 23 are currently active. These are very interesting statistics here. I like the transparency. It says the Monday is the busiest day. 31.6% of all transactions historically have occurred on a Monday. And then Wednesday, Thursday, Friday, and even 16.4 and 16.7%. Saturday and Sunday, not much action at all. That's because everybody's down at the pub on a Sunday or out watching the football. 0.2% of transactions happen on Sunday. They've had 6,080 deposits totaling £15 million. The largest single deposit was £300,000. I wonder who did that. Withdrawals totaling 13.0 million, an average of £1,158. So interesting. They've paid an impressive £2,083,000 of interest to investors through 114,884 unique interest payments. The largest single interest payment made to an investor was nearly $6,000. It goes on to talk about the largest single investment made in a standard account was more than £330,000, while the largest investment in an ISA account was more than $50,000. The majority of investments have been in bridging loans, 92.7% by loan amount. Buy-to-let development loans were only responsible for 3.18% and 4.49% of the loan book, respectively. So what else? 10,552 sales on the secondary market, with a value totaling of £5.9 million. So pretty active secondary market. At the time of writing, the total account value, cash plus investments for all accounts, is £4,086,000. The average account value is £4,870. Now, IFISA accounts have an average of £14,195. So really interesting data. I wish that other peer-to-peer companies would post this kind of data. I think we could all use a little bit of transparency in our life, and that's a good one. So that's Landlord Invest. If you want to check them out, go to landlordinvest.com. Another thing too, I always get the emails of what am I investing in myself right now within peer-to-peer lending, and I thought I'd just touch upon this very briefly to say that really nothing has changed with what I'm personally doing. Number one, just a disclaimer, you should never copy me. I've gotten it terribly wrong in my previous peer-to-peer lending days. Obviously investing, as you know, in some of the defunct peer-to-peer lending companies, because I think I had about 20 investment platforms at one time in my portfolio, which was crazy amount of over diversification, partly also because of the Financial Thing blog and the channel. I don't think I would have had nearly that, anywhere close to that, if it wasn't for the Financial Thing project. But obviously when you're invested in so many platforms, you're going to have some fallout from that. So I always tell people don't copy me. But right now, what am I really invested in? I would say it really hasn't changed. I mean, it's LoanPad. It's been the slow and steady one for me. Still, you're able to get that 6.5% in the premium. If you can put it into an ISA account, I think that's definitely the way to go. Why pay tax when you don't need to on your interest gains? Lend Invest. I still have a investment through them. Not a huge amount. It's definitely not one of my biggest, but personally only doing the real estate funds. I'm not doing the secured bonds. Sorry, not the funds. The self-select platform. Put it on auto invest. Let them select which loans the money goes into. I don't touch these secure bonds. Never been a fan. Never been a fan of anything secured bonds-wise, whether it be in peer-to-peer or even through stocks and shares, funds like that. I don't like corporate bonds at all. I just don't think they pay enough to make the risk worthwhile. I mean, look at this, 5.3%, 5.25% fixed. Not really attractive at all. So I've stuck to the self-select platform. Still got money in Assets Capital, unfortunately. Been withdrawing a little bit here and there. Obviously, that's going to end up being withdrawn down to zero at some point, hopefully. But I definitely know there'll be probably some losses in there. And then Unbolted just seems to really tick along as is at the moment. I just make sure I don't put too much money into any one of these platforms. As a CEO of a peer-to-peer company once told me, any single one of those companies, including his, could go under at some point. That's just part of the risk of investing. So I try not to put too much into one. And then, of course, we got Cufflink. And I do love their little learn more about peer-to-peer little animation they have there. That's pretty cool. Cufflink's been a tricky one for me because when they increase that £500 minimum, as a low net worth investor, and I'm very transparent about that, putting in 500 alone is something I've been really considering. Is that something I want to continue to do? Likely going to start using the auto invest product once my loans draw down, and I don't want to be putting £500 into each individual loan. That's just about where I allocate money, but I'm still continuing to use Cufflink and likely going to switch into their auto invest product. I mean, the 1-year product right now is offering 10.25%, so it's pretty attractive. Crowd Property, they've got their questions that hopefully I'm going to get answered in the middle of May when Mike Bristow comes onto the stream and answers some of those questions about what's going on, how are they handling the loans that might be considered past due or that are possibly in trouble. But I haven't really changed my investment amount. I'm still continuing to invest through Crowd Property. And then again, if I were doing things all over again, I would certainly look at introducing people like Capital Stackers, Folk to Folk, Blend, Network, PropLend, maybe Assets Exchange. So there's a lot of good options out there at the moment, but really my strategy has not changed at all. It hasn't changed for a couple, 3 years now. So for anybody asking, that is what is going on in my personal portfolio. Let's move on. Howard Marks has warned against the risk of not taking risk. I really, really like this title of this article. This is for people that are sat on the sidelines. I have a friend of mine that's been waiting for several years now to put money into to investment markets. He's afraid of the crash coming. Problem is he doesn't know when this crash is going to happen, if it's going to happen at all. We had this huge downturn in 2020, but ever since then everything has just been kind of going up, and then we've had some volatility recently. But he's just afraid of taking the risk. I mean, he's always been very risk averse. So this article was really great, and I think a lot of us could use to read something like this. But Howard Marks, who is a billionaire debt investor, has warned about the risk of not taking on any risk in their investment portfolios. This is something, too, that people who are closer to retirement really struggle with, because they don't want to have the risk of going too much into stocks and then having that reversal or that market correction happen, and their portfolio really suffers closer to retirement when they need the money. That's why, a lot of people are taking like a 50-50 mix of fixed income investments and then a 50% equity investment, so stocks and shares in their portfolios to balance it out. So you still get some of that growth, hopefully on the stocks and shares side, but you also get hopefully the less volatility of the fixed income side, especially if you're closer to retirement. In a new memo, the co-chairman of Oaktree Capital Management compared risk-taking in finance with the game of chess, where players may have to make sacrifices in order to secure a win. The risk inherent in not taking enough risk is very real, wrote Marks. Individual investors who eschew risk may end up with a return that is insufficient to support their cost of living, and professional investors who take little risk may fail to keep up with their clients' expectations of their benchmarks. The paradox of risk taking is inescapable. You have to take it to be successful in competitive, high aspiration arenas, but taking it doesn't mean you'll be successful. That's why they call it risk. I read something on Fourth Way's guides about, low risk doesn't mean lower risk. So when you invest in what's considered lower risk peer-to-peer lending, that doesn't mean that it's necessarily super low risk or no risk. There's definitely risk involved. That's why you get paid an interest rate for taking that risk. Marks noted that every type of investment requires the investor to make some sort of sacrifice. The greater the risk, the more real the sacrifice may be. Because the future is inherently uncertain, we usually have to choose between A, avoiding risk and having little or no return, or B, taking a modest risk and settling for a commensurately modest return, or C, taking on a high degree of uncertainty in pursuit of substantial gain, but accepting the possibility of substantial permanent loss, Marx wrote. Everyone would love a shot at earning big gains with a little risk, but the efficiency of the market, meaning the fact that the other participants in the market aren't dummies, usually precludes this possibility. A lot of people don't realize when you're buying a stock trading, you're trading against another person or one other entity. So when it says participants in the market aren't dummies, that also means the person that you're buying stocks from or selling stocks to, they may know a lot more than you know. Most investors are capable of accomplishing A and most of B. The challenge in investing lies in the pursuit of some version of C. That's taking on a high degree of uncertainty in pursuit of substantial gain, but accepting the possibility of substantial permanent loss. The challenge of investing lies in the pursuit of some version of C, earning high returns in absolute terms or relative to other investors in the market, requires that you bear meaningful risk, either that the possibility of loss in the pursuit of absolute gain or the possibility of underperformance in the pursuit of outperformance. In each case, the two are inseparable. And, I wish I'd read this article 20 years ago. I remember when I made a pretty substantial, for me, investment into an oil stock a long time ago. It's probably 25 years ago. And I was in pursuit of that C. And I wasn't a big investor at that time. I don't think I even maybe had anything else in the markets except for that one investment. I had a little bit of, funny money stocks and stuff from when I was a kid, like British Telecom and BP, stuff like that, but really nominal amounts. I remember I think I put 2,500 pounds into an oil stock, which for me back then was a lot of money. And that stock went to zero. It was Norseman Gold. I've talked about it before. Trying to obtain that version C of chasing after high returns, but without realizing that there was a possibility of complete loss. That was something I never realized. I didn't realize that there was a good possibility of what I was investing in could actually go to absolute zero. I thought for maybe, worst case scenario would drop 20% or 30%. But I had no idea that this stock would actually go to zero. And I would lose everything on that stock investment. Because I didn't realize that, what happened is I didn't make another investment in the stock market for a really long time because I got so badly burnt. And then my immediate default mindset after that was, well, if that could happen to that stock, that's probably going to happen to this stock. Well, let's face it, there's a lot of stocks and shares out there that likely are never going to go to zero. Things like Google or Amazon. It certainly could happen. Or Apple. Yes, of course it could happen. But it's quite unlikely. But I didn't realize that. And pursuing that high risk, high reward stock and being burned stopped me from entering other investments and stopped me from taking that risk for a really long time. And that actually really damaged my retirement cycle because I didn't really start investing into my retirement until I was in my early 40s. And if I'd have kind of stayed the course and had more education and known what to do back in my 20s and 30s, I would have put more money in every month, just squirreled a little bit away, made some alternative investments at that point. And I probably would be retired now at 51 years old, but I'm not because I cannot do that at the moment. So this is why this article really resonated with me, and I think this is a really important part of education that people need to understand who are willing to take risk on stocks that could give them a really big uptick. That you do have a possibility that stocks can crash and go to zero, even though it's highly unlikely in most cases. Marx recommended diversification as a tool that investors can use to reduce the risk of their portfolio. It's pretty common stuff that we talk about, but I love this line here. You have to take a shot, he wrote. This is something I wish I'd have known back then, that just because one doesn't work out doesn't mean others won't. You have to take a shot, Marx wrote. Not every effort will be rewarded with high returns, but hopefully enough will do so to produce success over the long term. That success will ultimately be a function of the ratio of winners to losers, and of the magnitude of the losses relative to the gains. But refusal to take risk in this process is unlikely to get you where you want to go. The bottom line on the quest for superior investment returns is clear. You shouldn't expect to make money without bearing risk, but you shouldn't expect to make money for just taking risk. Really important line right there. You have to sacrifice certainty, but it has to be done skillfully and intelligently and with emotion under control. Same goes through with peer-to-peer lending. If you don't take the risk of investing through some of these companies and through the loans, you're just not going to be rewarded with anything. Again, talk about diversification. The reason why I do this stream is to really educate people on the diversification. You don't want to put everything into one investment. So great article. You can Google it and read the article. It's by Howard Marks. It's all over the web right now. Speaking of stocks and investments and risk-taking, I found this really interesting graphic of meme stocks percentage below 2021 mania highs. So this is when a lot of the meme stocks like GameStop, BlackBerry, Nokia were raging prices in 2021, and just to see how far they have come down. So we have Nokia, for instance, down 63%, BlackBerry 89% down, GameStop 90% down, Beyond Meat. Look at that stock, went from $221 down to $662 at the time of writing in April of 2024. It's down 97%. AMC, of course, one of the Wall Street bet favorites, down 99.4%, currently trading around 2.6, 2.7 US dollars. And then, of course, Bed Bath & Beyond, which went to zero. It's a big retailer in the US, just to show you that stocks can go to zero. And then Blockbuster down 99.7%. Yeah, Blockbuster Video. You read that right. So you can take a huge risk, and people made a lot of money with these meme stocks in 2021. Things like GameStop, AMC, and look at Virgin Galactic down 98%. But if you held on too long, you get extremely burned. That is the risk and reward of those long shots. Another article, people criminally are underinvested in alternatives. Private credit should be part of everyone's portfolios. This is Anant Kumar, Benefit Street Partners, head of research. People are criminally underinvested in alternatives. Well, the reason why, Mr. Anant, people are criminally underinvested is because they don't understand what those types of funds are. So he suggests this Franklin Templeton private credit fund, which is only about $65 million in size. If you go to the fact sheet and look at what this fund is, your average investor, myself included, might have a really difficult time trying to figure out what exactly a private credit fund does, even though it may return great returns. I mean, this one's done 12.03% for a year, but that may also underperform the S&P 500. The minimum investment of $2,500. It's hard to really understand exactly what the fees are on this fund. A lot of mumbo jumbo, and this is why I don't think these funds are going to be naturally very popular with your average investor who's criminally underinvested, because it's just very difficult to understand. These are bond funds, basically, where people are lending, or companies are lending money, private credit, to a variety of different people out there, but just very small fund, 61.93 million. If you compare that to, say, the Bitcoin ETF, which is now billions of dollars of investments, these things are really, really small. And look at the leverage on these funds, 26.32%. So definitely a lot of risk involved in private credit funds. So not sure that I agree that people should really be moving into those. Let's take a look at an email that was sent in. the mailbag. I wish I had a jingle for the mailbag. Lawrence, hi Lawrence. Bit of direction needed if you wouldn't mind. Oh, that's what I'm here for. I finally decided to get off my bum and start investing for my future. I'm 26 years old. I never had much extra money, but I started a better job in late 2023 and finally have money to invest. I didn't think I had enough confidence to invest my own money, so I went to see a financial advisor. You should have watched some of the videos on this channel first. He recommended a portfolio made up of premium shares. I don't know where premium comes from. The shares he suggested are St. James Place, Legal & General, Rolls-Royce, Ocado, M&S, Marks & Spencer, Centrica, British American Tobacco, Prudential, Tesla, and AMD. The advisor's fee is 1.5% per year. He didn't talk about index trackers, and when I brought up the subject, he brushed it off. I'm totally confused on what to do here, as I have no experience in investing. Can you help? Pretty standard email I get from time to time. People going to see financial advisors, a place like Charles Stanley, where they're going to tell you, yeah, we can pick stocks for you and do better than the markets, which generally they tend to fail at. And if we look at some of these stocks, I mean, I know a couple of you out there are fans of Legal & General, St. James Place. I happened to pull up this Hargreaves Lansdowne chart today. It was really interesting. Actually, two of those stocks were on here as having a really nasty down day. We got St. James Place right here at minus 5.18% today, and Legal & General down 6.36%. Yeah, and I know the argument. The argument is, well, Legal & General is going to give you a fantastic dividend of 8.74%. But what people don't realize is these stocks are pretty volatile. They can be extremely volatile. So if we look at 1 month chart, we're going to see some volatility going there. And people always assume that things like St. James Place or and by the way, there was a dividend paid out. I understand that, and that's why the stock drops. I get that. But people, they don't understand that stocks like Legal & General that pay awesome dividends also are going to have this kind of fluctuation of price because, number one, when the dividend's paid out, the stock drops in price. And you also see some fluctuation here in price. Look at this. In late 2015, we were under 150, and then almost 5 years later at the same price. So not really any growth, but then you have these huge swings here. You've got where the price hopped over 300 and then of course came back down. This would have been during the pandemic situation, but you can see this volatility, and we're not seeing a steady climb up as you would hope to see from a really high paying dividend stock. So you are going to have some volatility there. Let's look at St. James Place, and another one that has a pretty nice dividend of 5.6%. But let's look at the charts on this one. So we have a 1 year. Look at this, 1,200 now down in the 400 range. And imagine this is a financial advisor who's telling this person this is a good stock to invest in. Maybe he's doing it because the price is low and he thinks there's some value there. But if you're looking at a 10-year chart, really it's not looking very good. Over here in 2014 it was a 750, climbed all the way up to here over 1,600. If you could get out at this point, good on you. Most of us regular folks can't know when that top point is. And then, of course, we've seen this horrible decline down just to get a dividend yield of 5.6%. So what are we going to lose in stock value to get that 5.6%? And that's 1 year of dividends. We're not talking about less than a year. We're talking about 5.6 a year. And we've taken about a 50% or actually more, 75% haircut on St. James Place stock price in order to get that 5.66%. So what is the answer? Well, it always goes back to the same thing, doesn't it? Gavin, if you hopefully are going to watch this, my good old trusty US equity fund. Look at this NAV price on this fund now, £903 now. This is rocking at 3,600 stocks. Personally, I don't think you could do much better than just popping it into an index tracker. And if we look at that email, he's also saying Tesla, AMD. These stocks are all in here. You know, you've got under the portfolio data. Let's look at it right here, see what's invested in the moment. You get access and exposure to things like NVIDIA, Facebook, Amazon, Microsoft, Apple. Keeps on going down. Of course, the heavy weight of the fund is going, even Tesla right here makes up 1%, almost 1% of the fund. But obviously you're going to be far higher weighted in these heavier market cap stocks, which really move the markets more than anything else, the Apples and the Microsoft and the Googles, Facebooks. But you're getting exposure to all those same stocks, at least the US ones that your advisor is telling you to put money into. This is a pretty high risk way to invest, especially since they are moving in and out and trading. They're going to charge you trading fees, by the way, every time they decide to sell something. And some of these stocks, honestly, are just stinkers. I mean, Ocado, I wouldn't take a sniff at it. Yeah, so be very wary of those things. Another thing I like about the equity fund, the U.S. equity fund, is they don't turn the fund over a lot. You can see right here, turnover rate, minus 4.5%. So what that means is a lot of people that are trading stocks, financial advisors, they're going to have a high turnover, which could be 30, 40, I've seen some as high as 70 or 80%, which means they're trading out 80% of the stock portfolio every year. And what that does is it creates trading fees and also tax liability. Sure, you can get some tax losses when you trade out of bad stocks, but you're creating a lot of unnecessary tax situations. And this is why these index trackers are so tax efficient, because they're really not turning over the stocks very much, which means they pay less tax, which is a benefit for you, because when tax is paid, it gets paid out of the fund, and that falls on the investor shareholders. So you want to have funds that have low turnover rates too. So Gavin, I hope that answers your question. You know, I always say you don't need to be paying a financial advisor 1.5% a year to be putting you into shares like this, because I think you'll find over the long run, if you just move into an index tracker, it's going to outperform anything that a financial stock picker can do, unless he gets very, very lucky. And I'm presuming he's one of this advisor at one of your high street advising firms, probably like Charles Stanley, even though you didn't mention the name. But just shove it in an index tracker. And that way you're not going to be worried all the time about looking and seeing this negative downturn one day if in the red of 5%. Your index trackers are not going to move like that. They might move 1.5% in either direction. That would be a big loss day or a big gain day. You're not going to get emotionally tied to these stock prices moving. Trust me, when you start buying individual stocks, you're going to watch them every day. It's going to drive you crazy. So Gavin, that'd be my advice to you. Just ignore this. Use your ISA to invest in index trackers, and you know, whether you go through Fidelity or Vanguard makes no difference. All the same thing. Speaking of Fidelity, I saw this graphic. It said you should save X of your starting salary. So when you're age 30, you want to have 1X of your salary saved. So for example, if you earn $60,000 a year, by age 30, you wouldn't have $60,000 in saved. Now, I don't know if this means savings account. I'm presuming it means invested because it's Fidelity. But then you go all the way up to age 67, which is saying 10x of your salary. So if you earn 60,000, that's your salary. At 67, you want to have 670,000 pounds or dollars or yen, wherever you are, invested in your investment accounts. I think that's a pretty good general rule of thumb for most people, depending on what your expenses are every month as you get towards retirement. But I like that chart. I think it's very informative. This is interesting. Top performing UK shares rises and fallers during March 2024. So if you are into the gambling aspect of picking out stocks, these are the ones that have done well in the UK during March. Personally, I wouldn't hold any single one of these. Look at this. Funding Circle Holdings up 57%. So there's a familiar name. Virgin Money up 38%. And also, here's on the other side, the worst performing stocks in the FTSE All Share Index of 2024. Vanquis Banking Group heading it up, minus 56%. Ceres Power, that was a stock that we used to hold in the Trading 212 portfolio. Pretty crazy. I'm glad we are not in that one. We got Octopus Renewables Infrastructure, down 14%. So you can see some of the bad ones here. Trading 212. Let's see what the portfolio is doing. Hang on one second. Let me just log in here. I'm going to show you. Not really too much movement at the moment. We've had a pretty volatile week. We've seen some movements of, in the general broad markets of minus 1.5% up and minus 1.5% down. We had a bad stock market day today because the U.S. released its gross domestic product numbers, and the growth has been much slower than was anticipated. So the markets have kind of, earlier this morning, I think the S&P was down like 1.5%. It's rebounded a little bit. But you can see here we're at a 19,614 pounds, so about a 100-pound difference from last week. But the portfolio right now has 9,000 invested, and I'm really sitting on cash. I'm thinking that May might be another entry point. I want to hear what's going to happen with the U.S. interest rates. I personally don't think we're going to get a cut, but you never know. So I think May might be the time to go back in with some of this cash to redeploy it. We got about 10,000. It's getting a little bit over 5% interest a year, so we are getting some interest on the money. You see Coinbase has pulled back quite a bit, 76% in the green still. Nothing really much to report. Valco's still in the green. Alibaba are about the same, up a little bit from last week. Creative Realities. This one has just been crazy volatile. You can see here over the last week, just up, down, up, down, up, down, up, down. And just waiting for something good to happen with that stock, which who knows? We'll see what happens. My average price in was 361. I bought some when it was lower in the 330, and I bought some when it was higher, so it's averaged out. But the portfolio is just kind of really ticking along, not doing much at the moment. I thought it also was interesting to go back in the history and look at some of the very, very early trades. If I can scroll, see if it'll let me scroll back. And just see when we first started out, and this would have been in 2020, I believe. Bear with me for a second. I go all the way back, keep scrolling. I have this cool mouse that just, the wheel keeps spinning, so it lets you go back. You'll see some of the trading. I just saw Virgin Galactic on there, which, let's see, we had Tesla back in, this was 4 years ago. I bet if I looked at some of these stocks now, I'd wish that we'd have held on to them. I do believe that Tesla back then, I would have been after their stock split. So 381, look at that, 381. And right now, Tesla is trading at let's see, TSLA stock price. Look at that, 168. So they've had a really rough month. Really big downswing from over 180. So that was a one that I'm glad that we exited out of. Of course, we've lost the history there, but you know what? Oh, here we go. Yeah, we exited out. Well, we bought in at 381. So if we'd have held that in the portfolio, that would have been nasty. We had Lloyd's Banking Group, which that was another one that was exited. I think that stock price when we traded out of it was about 59p. And I think Lloyd's now is trading in the mid-30s. Let's look at the FTSE price. I don't know what it's showing me about. I think it's about 35p though. So that's kind of another good one that was exited out of. But some of them, I'm pretty sure will have. Oh, here's AMD. Look at that, 81.73. That was when we bought. I know that stock right now is. Oh, look at that. We sold out. I don't know why. $80.30. Let's look at the stock price of AMD right now. $151.17. So that's almost 100% increased. And selling out was not a good move on that. Well, of course, it was a small position, so it didn't really have much on there. National Grid, Shell. Oh, look at this. Virgin Galactic. Wow. $17.69. I'm not even sure why I bought that and sold it the next day for a penny more. I think these actually might have been free stocks. I'm not sure. We had AbbVie, Salesforce, Apple. Look at that, sold. Sold Apple at $118.28. That's now trading around $170. So you can see here the power of just buying and holding and not trading in and out. Let's look at Magnite. See what Magnite is doing today, 4 years later. $8.78. So that one was a good trade out. So we had filled at $14.27. So that one we got out of. And then Fastly, I remember Fastly. For anybody that's been watching the stream for a few years, you're going to remember that too. I think that was one we made some money on. $12.39 now. So Fastly, see, we sold at $81.20. So this is just the gambling of buying these individual stocks and trying to hit those really big gains. And you can see this was a loss of 18 pounds on that trade, but this is why it is honestly better just to shove it in index trackers, I personally believe. And yeah, here's another one, too low oil. Look at this one, too low oil, 33p. See if we can get the UK price. Too low oil, PLC stock price. Show me the. I want to see the UK. 35.44. Close this one out. 35.44. So, I mean, look at that. It's just not done anything for 4 years, and now 33p was our fill price. I don't know what we sold out for. I think we bought quite a bit though back then. Let's see if I can find a sell. Just keep buying, keep buying, keep buying. Bought more. Look at that. 500 pounds, 500 pounds. Too low oil. 9 pounds. Look, there's Sarah's Power that we talked about. 1,000 pounds of that was now 54% down in 1 month. A lot of oil stocks we were doing back then. Had a lot of too low oil. Trying to see where the sale is. I don't know. So there we go, sold. There we go, loss of 58 pounds. So we sold at 51.26. And you can see, if we'd have been holding to now, we'd have been absolutely lost money for the last 4 years. Not a good result. So this is why I would never recommend trading or trying to pick out stocks for most people, because those are real world results there. You can see from 4 years ago. Some of them would have won, some of them would have lost. Maybe the Tesla would have been a good hold. I think I had Microsoft. There you go, Meta right here. Meta Platforms, 378. I think that stock split, possibly. And that might be why the price was high, but You know, Meta, that would have been a good one to keep. That's trading at 445 US dollars right now. Actually, I don't think that stock did split. But again, trading in and out of some of these stocks has really been harmful to this portfolio. Some of it's worked out really well with the energy plays, but Meta, I think, would have been, see if we paid 378, so if we'd have held on to that, I think we would have made some 442. So that's about, I mean, that's only about 3% a year. They don't pay much of a dividend, 0.45%. So better off being in an index tracker than holding Meta stock all those years. So yeah, that's why I always tell people, just honestly, you don't want a headache of all of this stock trading stuff and trying to pick things out. Just go with the tracker. Just no headaches with it. You can just turn it off and leave it alone. Really, much easier. Anyway. One thing next week, Friday. We're going to do the live stream next Friday. Please hit that thumbs up if you can, if you're enjoying the stream. We're going to do the stream next Friday. On next Thursday, I have to go to the airport, so I will not be here. So next Friday stream, we got Natalie Weeks, May 9th from Cufflink. She's the collections person. She chases after all the loans that are past year in default. And then the 16th of May, we got Mike Bristow from Crowd Property. Other upcoming guests coming too soon, so I hope you enjoy. I think that is really about it. Let's see if you have any comments. I didn't do shout outs today, so hi Dave Dawson, hope you're well in Staffordshire. We got the Grand Caymans here. It's probably pretty warmed up. It's really warm here too. It's about 28 degrees here. So Chile, Nottingham, Stephen Hale, Colin Perry in the Peak District, Peter Vince is in Leatherhead, Mike Powell's here, Paul Bagworth is here from Kenilworth, John Day in Nottingham. Alan Stratford went first ride on the motorbike today. It was a mistake, too cold. You got to come ride a motorbike in nice, warm, sunny weather, Alan. George Batchelor is here in Bridlington. Welcome. All about risk-reward balance, absolutely. Dave Dawson got his first payment from Axia Funder this month. Very impressed with the returns. Nice. Just having a quick look through. Patty is here in France. Bonjour. Best day to buy legal in general. Yeah, you can get it at a 6% discount today. It's not bad. Invest in May. Don't they normally sell in May? They do normally say that, but you know, I've never really gone with the crowd. We're gonna see. We're gonna see if that works out. Oh, hello, Annabelle in Spain. Hope you're doing well. Paul Bagworth says, I work for National Grid, so that's a big income. Can I briefly talk about the Bitcoin split sometime, please? Yeah, I mean, basically every 4 years, the Bitcoin goes into a halving. I call it a ceremony, but it's programmed into the code. What it does basically is Bitcoin miners are rewarded with Bitcoins when they solve the mathematical equation. A miner is rewarded with, it used to be 6.25 Bitcoin when they were able to solve that mathematical equation, which is done through computers running GPUs. And then I think it was few days ago, I can't remember which day, and maybe it was last week or this week, Tuesday, maybe, but the Bitcoin reward halved. It was the every 4 year halving. It went to 3 point something. So in 4 years, it's going to halve again to 1 point something. And This is designed to decrease the flow of Bitcoin that comes into the market until all 21 million Bitcoins are eventually released and there will be no more Bitcoin. So usually what happens after the halving in the next 6 months is you see this definite increase in the price of Bitcoin. It's an interesting piece of the code as part of the Bitcoin protocol that cannot be changed. And yeah, that's basically what the halving is. There are some people who believe that when the halving happens, then we get this crash in price. Well, it hasn't happened yet. We've seen definitely some volatility in Bitcoin, but it really continues to still hold its own, and we are seeing a lot of influx still into the Bitcoin ETFs. I haven't checked the Bitcoin price. I'm a very long-term Bitcoin holder, so I don't necessarily pay too much potential price day to day, but let's take a look at it. $64,687. So yeah, I mean, it's still holding strong. You can see the volatility. Always remember, volatility is your friend when it comes to investments sometimes, especially in these higher risk, higher reward investments. You can see the volatility since March has been up and down, up and down, up and down, up and down. I think we see 75 to 80,000 will be our next move up. When it happens, nobody really knows. I know Germany released their own Bitcoin ETF today on the German market, so we'll see if that has any impact on the price. So yeah, there you go. I hope that helped. You can read out too online about it if you want. I think it's interesting stuff. Lionfish says Tulo used to be amazing back in 1997. It was 60 pounds. In 2012 it peaked at 1,330 pounds. Incredible. Then the CEO left. Yeah, that's the risk of those smaller energy stocks. Anyway, that's going to do it from myself and the absent Harley. We'll see you next Friday. We'll be here. Please, the man upstairs puts me here. I'll still be here, hopefully. We'll talk more about P2P lending, anything interesting in the news and investing. Hope you enjoyed the stream. Don't forget to like the video, subscribe to the channel, tell your friends and family about the video. And that's all I got. See you next time. Have a wonderful weekend. Take care. Bye.